Hello, Andy Tanner here. Welcome to Mentor Club. I'm joined by the indestructible Noah Davidson. You cannot destroy him, but he might try to destroy himself. So
Well, gotta test the limits.
no, you're a little nutty. I don't
I
think
am.
you feel any pain at all. Is your pain, have you just been in so much pain through all the health stuff you've been through that you're impervious to it?
I
Here's
don't
a
know
guy
about
who's,
that. Yeah, I've endured a lot of pain through other health stuff, but I tore my ACL skiing, and it
he decides to go on
doesn't
a
hurt
10
that
mile
much.
hike the next.
It,
I says, how's your ACL? He says, well, it's not very stable, but I regretted going on a hike yesterday in the mountains. He says, once I got 5 miles in, I was bummed because I thought I better turn around. I'm like, dude, if you can hike 5 miles anywhere in the mountains on a 20, you're kind of messed up, but a stud at the same time.
yeah, my wife just shakes her head at me, and I kind of enjoy. I don't know why. Something wrong in my brain. I like to test my limits.
Masochist.
Something like that. Something like that. Glutton
We
for
are
punishment.
we are about education. We are not about advisory services. So we don't solicit or recommend anything other than to get educated. We're going to use examples today, and I'll tell you this is a really important disclaimer every day, but particularly today because we're going to go through the four pillars on a stock that's a boring stock, and we're going to talk about fundamental analysis and technical analysis on a specific stock today. And that doesn't mean I'm recommending it for everyone, just because I may or may not have bought some. Uh, this training is also intended or not intended to solicitate anything other than education. Um, we don't make warranties because I'm wrong so much. And if you've been around long enough, you know that we are wrong sometimes, and sometimes we are right. But it's about risk management and Noah's ability to adjust trades and all investing in anything. Yeah, I'm tired of people out there on the internet plugging risk-free stuff. I guess as long as human beings believe what they're told out there, that they'll believe what they want to hear. And if they can say they make a lot of money with no effort, no risk because they want to hear that, it's emotionally satisfying. Um, Off it goes. They'll buy into that stuff. But if what I believe is if you're consistent in what you do and you have some basic principles, things tend to work out. They don't always work out perfect every time, but over the long run, I think you'll wind up with some assets and be very happy about what you did. So that's my feeling. There's the
Well,
disclaimer.
yeah, you
There
can't
it is.
get something for nothing, and I think consistency is key.
Yeah, I got we have a compliance officer that, what she does is look at, everything we say and do and says, hey, make sure you're compliant with the law. But I really, and that's a smart thing, obviously, but I really want to be compliant with myself too. I have kids. I've done, how many hours of stuff that's out there on the internet now. And when my kids grow up, I want them to say, hey, their dad told the truth. He wasn't one of these guys that was a wheeler dealer. And that's important to me personally. But anyway, our compliance officer, she sent me a a report from one of our competitors, and they're struggling because they are so up in the night. And I guess what they got in trouble for is they were cherry picking just winners, insane winners, and acting like, yeah, it's typical to get winners every time. And our mantra, I really believe when I started the Cash Flow Academy, I said, why didn't I like school when I love learning so much? My wife was talking to me. I was doing a podcast and she was listening. She goes, "Hey, you know all this stuff." I go, "Well, I don't. I'm a student, but I love to learn." And I like, why didn't I like school then if I love to learn? And I decided I didn't like school because it wasn't fun. I hated school because it wasn't simple, or maybe I was just dumb, and I'm open to that idea because we have plenty of evidence for that. And a lot of what school taught was not real. They did not teach the truth every time. They didn't, like they said, hey, the best thing you can do is get into the rat race and get into it deep. And I don't think that's true. I don't think that's the best thing you can do. So and they taught me a lot of things that weren't applicable that I could really use. So when I use the word real, I couldn't really use that, and meaning that it wasn't applicable in reality. It's something I couldn't use practically. It was theory, but it wasn't practical for my life anyway. So some fun, simple, and real is what we do here. So with that, let's look at the market, man. Let's hop in.
All right. So, well, let's take a look at the S&P. And this market rally has been, I think, as far as the price action goes, probably a little better than I expected out of the market. Like, I haven't had a lot of confidence in the rally just because of the volume tapering off and looking at some of the fundamental questions that I have about the market.
Yeah.
And from a technical perspective, it put in kind of a triple bottom, and it started to rally, and it got one good pop on some above average volume. And then it has continued to rise, and it got back up above that 200 period moving average, and the volume's kind of been down here a little below average, and that doesn't necessarily mean that it can't continue to rise. It just means that the levels of participation during this rally have been below the average, and the average is up a little bit because there was a lot of participation during all the volatility.
Yeah.
And so this is common. I do see a slowdown out here. I do see some overhead support and resistance thresholds that the market previously established, and I see this 100 period moving average as well. All of those are possible technical reasons. People might look at that and say, oh, well, this might be a good point to sell because prices are slowing down or done rising. But there's, that doesn't necessarily mean that that's what's going to happen. That just means that's what I'm seeing in the market right now. It is slowing down a bit, and I wouldn't be surprised if we saw a correction. But other than a 1 or 2 day correction, possibly building, I don't really have much of a prediction for the market direction long term. I think that's one of the things about technicals is it gives you a little bit better read of what's going on short term, just by looking at how the behavioral patterns are shaping up. But it really doesn't give me any long term prognosis. So, and that's where we come back to the fundamentals. And so we've got, the Fed's raised rates, and they only raised them a quarter. Yeah.
But they didn't raise them by half point.
Right.
And there's the whisper, and then there's the news. And what's interesting is satisfaction or disappointment is a function of expectation. So if the market expects one thing and they get something better than expected, even if the news isn't the best news they could get, like the best news would be zero interest rates. That's what the market likes. But it doesn't really matter because they were expecting probably a half point and they got a quarter because of the war, probably, which I don't understand because I think the war is inflationary anyway. But
yeah,
say, oh, we need to help you though. So I don't know. They're pulling their levers and doing what they do, and it's tough on them.
Yeah, and it will be interesting to see, they do have a projected plan to continue to raise rates through the remainder of the year up to a target just under 2%.
Yeah.
And the market starts to already anticipate that because they give that kind of expectation. The market's able to take that information and digest it just as that is it's a possible future expectation. And then if they do end up doing another quarter point rate hike in the next 8 weeks or 16 weeks or whatever, that's usually how often they go between their meetings, is about 8 weeks. And the market will have already potentially priced that expectation in. So if we do see another little quarter point, they go, oh, yeah, well, we knew that was coming. If they were to accelerate it a bit and maybe do a little bit more aggressive half point rate hike, then maybe the market reacts and starts to think, oh no, well, maybe inflation's a bigger deal than we thought. But I think inflation is still a concern for people, and they feel it in their pocketbook. They feel it when they go to the grocery store, but the markets go up
Yep.
on an average with that inflationary pressure.
Yeah, I mean, dollars get worth less. They can buy, less stock. It takes more dollars to buy the stock. Takes more dollars to buy everything. Let's check in on wheat just for fun.
On wheat,
Yeah, I was talking to my dad last night. He's, getting older, and he was getting a little vertigo, and so my mom took him to the emergency room, and so I went in there. I was talking to him, and he's laying there in the bed, and they're checking him for stroke, and he wanted to talk about wheat. Wow, never wants to talk about this stuff, but it's kind of just hanging out up there, isn't it?
it is. It's got, I would call this a pennant pattern.
Yeah,
And as far as the
right.
technicals go, this is kind of a fun conversation about technical analysis, is what it,
Remember what
what
we
it
were
can
talking
do and what
about? Remember what we were talking about last July, though? We were saying, hey, if you want to hedge inflation, you know, get a little wheat here.
yeah, get we talked about basic commodities. We talked about
Was it this chart or the corn chart that we showed? I think it was
we did
this.
both. We did corn. We did like the agricultural stock. What was it called? DBA, which we still have a position on. We were looking at the consumer staples in general. Like we actually looked at a handful of things in anticipation of inflationary
One I
pressure.
put on was the consumer staples. That was the one I put on. I didn't want to bet on one grain,
Right.
but
And I've got a position in the Mentor Club portfolio here on DBA, I believe it is, which is the agricultural um it's an agricultural ETF.
yeah,
And yeah, and so it's and we've got some long calls on it that I was thinking about trying to go risk free on. So we've held these leaps, these long-term January leaps that are performing well. We've got a nice profit on it, but we still have some risk, about $2,100. And I was thinking, well, we could get rid of the risk if we were to sell some calls against our position at a higher strike price. But that was the same thing, and I can't even remember how long ago we talked about that. We talked about
so
that. It's
it's in the
been,
yeah, I think it was in the summer, but
yeah, so quite some time now.
uh,
So yeah,
up.
and I think that price of wheat is up, and the pattern was that we call that a pennant, which is just prices ran up and they're consolidating, and from here it could go up or it could go down. This pattern is popular because people believe it gives it a statistical edge to the upside.
Yeah,
So, and that's certainly possible. I have a few friends who are farmers, and they're very concerned about fertilizer, because a lot of the fertilizer supply comes from abroad, and they're concerned about just supply chain issues with that, and they've got a lot of pressure to produce more because the the global wheat market we're seeing that big price run up because
doesn't Ukraine? What?
Ukraine and Russia combined make up about 25% of global wheat,
Yeah,
and
that's a
they're
lot.
they're kind of European. They call it the breadbasket of Europe.
They're
And
not
China produces a
Iowa.
ton. India produces a ton. The U.S. produces a ton.
Yeah, it'll be interesting to see how that works out because they can't plant right now. They're a little busy over there.
Yeah.
They're not going to be planting. Maybe they will. I don't know. I
Well,
mean,
and
I
then yeah,
turn my butt off to plant. I bet if you can't ship it, you can't move it. Maybe it's too much of a risk to plant. You know?
well, and then other countries like China's keeping their wheat at home,
Yeah.
and India is exporting less, and so that means here at home,
Everyone's
and
hungry.
where we live in the U.S., that just puts a lot of
Yeah.
pressure on farmers to produce.
Particularly, Putin's really messed this up. What a great lesson about political risk. I mean, there's legislative risk, there's political risk, there's interest rate risk, there's systemic risk, there's non-systemic risk, there's geographic risk. You list all the risks, and we haven't talked about political risk in a while, and it's just a reminder that it's just weird having a crazy person. I feel bad for everyone over there. I mean, it's just Every day I think about those guys on every side of it. I think about Poland trying to receive millions of people. I think about, man, it's rough. Well, let's talk about this. Let's go back to, let's get in the main thrust of the four pillars on this stock. Let's go back to the S&P. And what's nice about the market is it's liquid. It is a liquid sucker. And so you can make some decisions quickly and get back out if you change your mind. And a lot of things, I like to do some pretty good research before I take a position, but I don't worry too much if a stock has a good if a stock has like Kenny McElroy can look at a real estate deal and make a decision pretty darn quick. And then but you have to go in a little bit more thorough those, because once you do that deal, your debt's there, your equity's there, for the equity you raised, so that's a form of debt. Raising capital, borrowing the equity. My gosh, it's a mess to unwind. So you got to get it right. Stocks, if I see a financial statement that looks pretty darn decent, I'll get it. And then if I dig a little deeper and don't like what I have, I can get rid of it. And that might be the case here. But as you see that drop, we had that, well, there's a rising wedge and there's a falling wedge, and this was kind of a falling wedge, and it quit falling and popped right back up. Yeah, there you go. There's your falling wedge, and it popped right back up. And it was during that period of time of that falling wedge where, we were looking for opportunity. And I love to sell puts on stuff that I might want to own someday. So I ran a search, I ran a scan, and I use the same scans basically that I share with everyone in Four Pillars. They're very basic scans, because if you read, Benjamin Graham, basically it's earnings and growth. You want good earnings, you want good growth, and you want to look at companies that seem to be doing things that might cause some growth, or doing things that might improve themselves. So let me show you, a little company that came up in a scan, and well, maybe I should just, show it to you. Should I just
Yeah,
stop?
you want me to have you share the screen?
Yeah, why don't we do that?
All right. You should be able
Am I a organizer or anything like that?
You are an organizer, so you should just be able to take it and.
I'll just take it. Make me the
go.
presenter. Here we go. Okay, can you see my screen somewhat?
Yeah,
It's blank, so I guess you
can.
can see much on there. Let's see. Let's find this right here. I guess I should sign in before I bring it over off my other screen. So let me get. Shoot, I don't even know what. I got like 5 usernames here for an account on this thing. Hopefully, it don't make me go to an email and have to do all this. Okay, so here we go. So this is free, and I have a bunch that I use. If I want to find, searches and scan tools, my favorite's probably Finviz, and that one costs money. I think I pay maybe $30, $40 a month for that. Yahoo Finance is nice. IBD is something you can subscribe to and get their leaderboard. Finbox Finbot, not Finviz.
Finviz is free and subscribed. Like you can get the free without pop-ups. You can subscribe and get rid of pop-ups.
But Finbox is my favorite. Excuse me, not Finviz. Finbox, that site is freaking awesome. I love that site. So anyway, these are the ones you see us use a lot in Mentor Club. They're the same ones I use. And I'll run a screener, and I have 2 saved screeners, bullish and bearish. That's it. And so you click on bullish, and it'll give you a bunch of stuff. Okay. And this is the criteria. We want big stocks, we look at, I want stocks that are more than $10. I should probably put that to 20, but sometimes you can find a really good deal. Like, there was a point where AT&T was like $23 or something, pretty good. This EV over EBITDA is a big deal. The enterprise value divided by the EBITDA, and this is very similar to cap rate in real estate, in that cap rate is NOI divided by the price.
So just make sure we're on everybody's following. Cap rate is your real estate term, right? Like you're talking about. Yeah.
Yeah. If I look at like price, whoops, how come if I look at a PE ratio, that's the price over earnings. Well, if I look at cap rate, that's net operating income, which is, what is earnings? Earnings is the money coming in, right? What's NOI? It's money coming in. What's EBITDA? Well, that's earnings. So all, EBITDA, all of these things are earnings. So this is a stock thing. Real estate is NOI divided by cap rate, or by price. So it's the same number, it's just the ratio is different, right? So you want a really low PE, but you want a really high cap rate, right? And cap rate just means your rate of earning money, right? What is the rate of your capital? How fast is your capital going? So you take the earnings, or the income, divided by the price. Now, why do they take NOI, net operating income? Because it doesn't count some of the things that are normal, like paying off the debt.
Right.
And so very much, instead of earnings, we use earnings before all this stuff. So earnings, EBITDA to stock, is very much closer to NOI in real estate.
Well, yeah, my wife and I were crunching NOI number, or we were crunching cap rate numbers last night on some real estate properties we're looking at, and
nice.
It's interesting to equate these.
Yeah, I mean, and we do this in the 4 pillars class, right? This should be a review. And then we take, well, some people say the price is the value. So we take, what's the enterprise value? And enterprise value is simply what? Well, it is the market cap, all these terms, added to the balance sheet, basically. The debt you take in, like, let's say, what are you buying when you buy the company? If you bought every share of the company, you'd be paying, the price times the number of shares, which would give you the market cap. Then you'd say, once you paid that price and you had all the shares, what would you have left? Well, you'd have the balance sheet. So you'd have to subtract out debt and add in assets, and then you'd really have a pretty good value of what do you got, right? So you say, look, how much money can we make based on what we have, right? How much money can we make based on what we have? Well, how much money can we make based on what we paid, right? How much money can we make based on what we paid? And so all these numbers are similar. But the most important thing, I think, to understand, if you want to get into those numbers well, is understand how they relate on the financial statement, right? What does it mean on the financial statement? So anyway, it was interesting, as I brought up these, because, I own a lot of this stuff anyway. It was funny how it came up. Like, I own ExxonMobil. I got a nice size position there. Rio Tinto is what they used to call Kennecott Copper. I used to work there as a kid in a really crappy job, So some of these, came up, and you can sort them by price, or you can sort them by, whatever you want. You can sort them by name. And, one of there's several pages here, 25, shows 25 rows and a few pages. One of them came up was international paper. See if I can go back here. International paper. And it's $45 a share. It's down about 1% today. And there's three parts of a financial statement. I'm going to go through this with you guys a little bit more detailed, because 4 pillars is supposed to be learning it, and then Mentor Club is supposed to be doing it. So I'm going to walk you through just the stuff that, like, there's so many numbers, right? do I care about all these numbers? Am I going to really go through line by line and look at all of these? No, I'm probably not. I just want to make a quicker decision here, and I can change my mind later. So the biggest one that I want to see is net income. I got to put my glasses on so I can see this stuff. Everything's gotten small, Noah. Hang on. The old man Andy's wearing glasses. When I put my reading glasses on, my kids make fun of me. All right.
I bought myself some progressive lenses, Andy, and I can't wear them yet. I haven't figured it out. Ooh.
Oh, I'm telling you, it's bad. Okay, this is your big one, and different companies call this different stuff. You know, the bottom line. Well, here's not actually the bottom line, is it? But you know, it's the net income from continuing operations. That's really important. We're going to talk about three kinds of income, and we're going to kind of look at it to understand what they're doing, and we're going to get what's called a narrative, or see if we can tell the story of this company. So they're holding strong from this is, you know, at the end of 2021. This is their trailing 12 months. So similar number there. Really rough year in 2020. And I was surprised at that. I was a little disappointed at that, because I would have thought that might have gone up because they sell cardboard. And I thought people probably shipped more than they shopped in 2020, but you also have labor problems, and they might have just not been able to make a lot of stuff. I don't know. And then they're about here. So they're down from, you know, 3-4 years ago. So that's not good. Okay, that's not good. So that's kind of a negative. But, you know, to find the perfect stock is tough, and they're still making, you know, quite a bit of money, you know, in this. So there you go. Now, that's their income. So their income, a little down from where it was 4 years ago, but you know, close to where it was here. You know, that's not too bad. So that's the income statement. So let's draw what that looks like over here. Is we had income minus the expenses, and then we had what we call the net operating income, right? Net operating income. What was the bottom line here? Net after and I would look at also, I would look at revenues, you know, the total revenue. And I see here, this is really interesting. I see here that they've had a drop in revenue, you know, not too bad, but from that nice 4 years ago, you know, they've dropped revenue from 23 to 19. So I've got to keep that in mind, right, as I look at this stuff. And you can go through and look at the expenses if you want to, okay? But I can know what that number is because I know what those two numbers are, right? If I know the net operating income's 1.2 and I know the total income's 19, that gives me an idea of what the E is. Okay, balance sheet. Second part of the financial statement is the balance sheet. You know, people often ask me, hey, Andy, will what you teach work in my home country? and I just want to say, I understand the question, but I want to say, well, show me a business that doesn't need income, expenses, assets, and liabilities. You know, it wouldn't matter. And show me a thing with a price tag that doesn't have a chart of technicals, right? It's universal. Now, this is where things got a little bit more interesting to me. As I say, this is interesting, is their assets went from 33 to 25. That's a big drop. And I thought, okay, why is that? Why did their assets fall? But what was really the biggest drop is their total debt fell, right? So the assets went from, you know, 20 or from 33 to 25, right? But the debt, look at this, went from almost 17 to 8. So more than they got rid of more than half their debt and most of it came last year. They cut their debt in half last year. So, when I look at those numbers, we had, what was it, 19 here and 1.2 here. So they're earning 19, 1, 2, that's a lot of expense, but they really reduced their debt. And to me, that's some pretty good strength right there. Okay, that's pretty good strength. They have a lot of investments, right? A lot of investments, and so that's their total debt, right? And net debt and total debt very, very close, very similar. Okay, now that's their financial statement. So the question is, what did they sell? Because if you go from 33 to 25, that means you sold the house and paid off the mortgage. Does that make sense? In other words, if you had a portfolio of assets and went from 33 to 25, you probably sold an asset. It isn't like your assets dropped in that much value. You probably sold something. And you know what? Whatever was financing that thing, you probably got rid of that too. And so this is a pretty good trade because this was cut by maybe a third, but the debt was cut by half. And that puts them, I believe, in a stronger position. And what I really think is interesting about that is you see this massive difference in the equity, and you see this massive difference in the debt. But if you remember, we didn't see that. I mean, it wasn't that big of a difference in net income. Maybe a little bit. I mean, I don't know that that's quite a third. I mean, from this year to last year. I mean, it looks like by getting rid of half their debt, it hasn't hurt them that much in income, meaning that they got rid of a business that probably wasn't doing very well. They're probably cleaning house, which I liked. And that's really what they're really making major moves to their balance sheet, and that tells me, like if you sit down, and this might be ultra overly simplified, but if you sit down with your wife or your spouse and you make major changes, that's usually because they were thought through and things are going to change, things are going to move. And so they made a major change in their business by removing that debt and getting rid of something that they sold, some business they sold. And I go research that further and figure out what it was and go read and look at what it was. I can delve into that later. I don't have to do it now because if I don't like what I find, I can just sell it. I can just get rid of it. But so far, I like what I saw here. Now watch this. I like it when CEOs, like, let's say you lay off a bunch of people. Well, no one likes to get laid off, but if you lay off a bunch of people, that means your revenue is probably or your bottom line is probably going to improve, right? You have less costs, so you just increase your cash flow if you laid a bunch of people off. Big moves like that get my attention. I say, well, maybe they're going to make some noise and do some things. Their competitors have been beating them. They've had some competitors that have had better numbers than they have, but these guys are huge. They're big. Okay, and they make cardboard. Now, watch this. So we have the income statement, the balance sheet, and I draw lots of these. This isn't something that we haven't seen in the past. We've seen this stuff before. What about the statement of cash flow, right? What about the statement of cash flow? So let's look at the statement of cash flow. Now, what is the statement of cash flow? This is fun to teach and learn about, okay? So here's how I teach the statement of cash flow. Let's say they just had a basic bank account, okay? And in that bank account is where they hold their cash. And we're going to see where stuff flows into that. And we're going to see there's 3 different places that cash can flow in and out of that, right? For example, let's say that you do some work, which is what we call operations, right? And they often call this a going concern. In other words, if you, if you go bankrupt, you're not concerned with it. You're not concerned anymore. You're done, right? But as long as I'm in business, I'm concerned that I can keep going. So they call it a going concern. We wake up in the morning and we're concerned that this will go on. Another way we say this is we're going to have what we call continuing operations. We're going to continue to go to work. So they call this cash flow from continuing operations. So we could have some money coming in here from this, which is called right here, which is called, we could make deposits from what we call operational cash flow. Operational cash flow. So in other words, how much money went in the bank account from the work that we did? Okay, from the work that we did, right? How much money came in for the work that we did? Now, if I went and sold something, right? If I sold something, I could have cash flow come in if I sold some stock. In other words, when I sell some stock, the money in my account goes up, the money market, right? The amount I have. So let's say I sell a bunch of stock. So this is what we call investment cash flow. So the cash flow came into the bank account because of something that I sold. Okay, I could also borrow some more money. And so this is what we call finance. Okay, from finance. We have operational, and sometimes they use different words for this stuff. That's basically the three that we look at. We say how much money came in from the work that we did, how much money came in from the assets that we sold, and how much money came in from the money that we borrowed. Because when you borrow money, what do? They give you a cashier's check or they deposit it in an account. So you can get money in the account by borrowing it, selling off assets, or doing lots of work. Now, the opposite is also true. If your expenses are too big, you might have to draw money out to cover your expenses. So you'd have a negative operational cash flow. You might take some money and go buy another asset. Well, that would be negative investment cash flow. And you might pay off a loan, which would take money out. So those are the three areas, right, that money could move from. There's only three places you could really go: is what you're doing operationally, which is money in, money out, what you borrow, and what you sell in terms of your assets. That's really the only place it can go. So this is called the statement of cash flows, and they often put a plural on it because there's three, right? It's the statement of the three cash flows. And so if we look at their statement of cash flows, we have the three, okay? We have the operational cash flow, made some pretty good money here, right? You have the and particularly, here to here, you have the investment cash flows. So they sold a business, didn't they? See, they sold a business for $6 million here, and then they paid off $7 million of debt. And you can tell they were probably upside down in this business. Which isn't really bad. I mean, if you can sell it for 6 and you only owed 7, you're not that far upside down. There's people with houses that are more upside down than this. So there you have it: operational, investing, and financial cash flows. And this is the big move right here, is to see that they sold, they probably sold a business, right? Continue cash flow, continue an investment, right? Capital expenditures is when you have a shitty trade, or a bad trade, sorry about that, a crappy trade. And you can see that the net purchase and sale, they didn't buy very much, or they purchase and sale, they had a positive there. And then here, net business purchase and sale, and you can see there's the sale of the business. There it is right there. And then you have net investment, financing cash flow, and you could break this down into, different type of stuff. And they got rid of these long-term debt payments right here. So there it is in detail. You can find it. They sold this business and they paid off the long-term debt. So by paying off that debt, they have a stronger balance sheet, in my opinion, and it didn't kill their cash flow. It just seems like they unloaded something that they won't have to spend as time on it now. They won't have to put attention to it now. They won't have to put in resources. And what happens is I'm not a gardener, but I'm going to be. I'm working on it. We've got a couple plants that have lived. You know, the most important thing that's lived is my kids have lived. Those have stayed around. The plants, we haven't done as
Well,
well.
if the plants, kind of whined and told you when they were hungry and thirsty and stuff, they'd probably have a better chance of surviving.
But I do know this, if you have an apple tree and you start to bud a cluster of apples like this, if you prune, if you look at these apples and I say, okay, here's these apples, this is what they say. I don't know if it's true. If I prune those three small ones, all of the energy that was going to go into those three will now go into that one. That's going to give me a nice big apple, right?
Yeah.
If you have a plant that's growing like this, right? And you see a couple of leaves that aren't doing as well. If you take out, and it's kind of like a wound, like if you have a wound in your body's going to spend a lot of energy trying to fix it, right? Well, with plants, what's nice, we can just kind of cut this one off and cut this one off, and then that energy, instead of trying to go into the stuff that sucks, goes into the stuff that's good, right? Instead of going into the small apples, we're going to put all our energy and get, I'd rather have one nice, big, beautiful one. And it's kind of nice because these can make the tree too heavy. And, it's just pruning is a good thing. Burning the vineyard once in a while isn't too bad. And so I think they've pruned some stuff, and I think they can take energy now and put in that. So, am I making a case? Now, I always say that if you can't poke holes in the asset that you're buying, if you can't poke holes in it, you probably don't know what you're doing. And so, yeah, there's problems, and you don't want to be dogmatic. It's one of the most, I tell my kids, I says, look, your dad doesn't know much. My dad, when he raised me, it seemed like he knew everything, but he always knew what to do. But I'm not a dad like that, man. I rarely know what to do. I tell my kids, I go, you guys are in huge trouble because your dad's in his 50s and I still haven't figured it out any more than I was your age. So hopefully you guys can figure it out and teach your dad. But I go, here's my opinion on life. You got to have self-discipline. That's the victory over self. It's not the government you worry about. It's not the employer, all this external crap. If you just say, look, what can I do better? Like, you can find yourself as a victim of anything, and we can always find people bigger victims than us who had, less blessings and started off. My kids, I hope they know that I think they freaking got it pretty darn good, even though their dad's not very smart. But whatever victimhood I have, if I just say, look, what can I do with my own choices every day? And what discipline can I have? That's number one. Number two, be kind to people. I know a lot of wealthy people aren't kind, and you take them the good that people have, and you shrug your shoulders at the bad people have, but you want to be kind. And then the other one I say is I go, listen to what Steve Jobs said. The third one, don't be trapped by dogma, man. Don't be caught by my thinking or anyone else's thinking. You have one life. Your time is limited. Don't live your life living someone else's life. Don't be trapped by dogma. And what dogma does is it creates a prison of allegiance. In other words, we're addicted to being right. This is really important when you do fundamental analysis, this temperament talk I'm giving you. It's not just about the numbers. It's about, like, you have the numbers, but then you have your temperament towards the numbers. I think this is the hidden genius of Warren Buffett. I think this is the genius we see of Warren Buffett. I think this is the one that the genius of his fundamental analysis eclipses the genius of his temperament. But for example, there's a study with Harvard that says human beings get a dopamine hit for being right. Now think about what that means for a minute, Noah. That means that if you're a heroin addict, If you get a shot of heroin, it makes you feel good. And the thought of not having heroin, right? The thought of not having heroin makes you feel bad. So you get a dopamine hit when you think about getting heroin. And when you even think about going without heroin, your dopamine goes down. All right, let's talk about being right. People get a dopamine hit when they're right, and when they're not right, they just can't. There's an emotional, chemical thing that's happening in my body if I'm not right. And dogma declares what is right. And so what we do is we say, this is my opinion, and we begin to defend it and build a fortress around our opinion, right? Defend from other people. See, I'm building my little rocks in my fortress to defend myself from all the attacks from everybody. And guess what? Now I'm trapped. I'm in prison. I just built a prison. I'm trapped by my own dogma. And so I really, I fiercely defend my independence to think how I want, regardless of what groups I might look at or be a part of or not be a part of or whatever. I fiercely defend my right to think freely, and I'll eat from tables that I want to, like, a smorgasbord, but I won't drink the Kool-Aid at the smorgasbord, right? I won't drink the Kool-Aid because I don't want to drink the Kool-Aid. And so what happens is when people invest, they start doing this. Let me show you how this works with investment and temperament. What happens is they say Bitcoin is awesome. And I say, no, it isn't. I go, Bitcoin's not awesome. And they say, oh, yes, it is. And what do they start to do? Well, Bitcoin, and these are all the reasons Bitcoin's great. Well, it's global, and it's secure, and it's double checked by everybody, and blockchain's awesome, and it circumvents the central bank, and gold's antiquated, and I can take it with me on a plane, I can use it to shop, and everyone else likes it, and boom, and pretty soon Bitcoin is the end all be all. But if I can't poke a hole in Bitcoin, I'm not going to see the truth. If something about Bitcoin is negative, makes me sad, I need to know that. And so, for example, the biggest reason I think Bitcoin will not last forever is the environmental impact of having 8 zillion computers check that ledger every transaction, every time, and constantly trying to figure out the next puzzle, and constantly having to check each other and verify as the network grows. The carbon footprint for that is just not going to get smaller. And I just believe that human beings, when there's a problem, someone says, well, let's solve this problem. And eventually someone's going to say, hey, I've got a better technology than the 8-track tape. It's called a cassette, smaller. Well, I've got a better technology called the cassette. It's called a CD. Yeah, but then you got to have the CD player. Well, I got a DVD. Oh, then you have a DVD player. Oh, now I have an iPod. Oh, now I don't have an iPod. Now I got a phone. We have podcasts. We don't even have iPods anymore. I mean, think about the craziness of that. Is no podcasts are played on an iPod. We have a word for something that's now extinct, where the iPod died, but the podcast lived. Now I have a freaking phone that works as my iPod. So the technology gets better and better all the time. And if we just say, yep, this is the last technology we'll need now, we won't innovate it anymore. There's no need to innovate in crypto. No need to solve any problems. We finally hit the promised land with Bitcoin. Nothing will ever be better than Bitcoin. You're up in the night. That's like saying nothing. That's like getting your new CD player, say, this is it, man. This is the gold standard. I got Mariah Carey screaming in my ear. This is fantastic. No, you're going to get better technology. You're going to go from wired to wireless. It's just going to get better. So don't be dogmatic when you build a case. So I build a case for this stock by looking at the fundamentals, by looking at this, and I found some things I liked and didn't like. But if I dig deeper into this and I find something I don't like, I'm out right now. I'll leave, because there's so many other stocks I could buy other than this one. Now, what I really like about this stock is its dividend. And could you bring up, so I think that's enough for me. Let's go back and look at the chart. Well, okay. I'll just draw this, what I do. So when I see the chart of international paper, I see it's got a long descent. And that's probably why they sold a bunch of this stuff. That's probably why they're making decisions. That's probably why they're still making money, but their stock price has fallen. And to me, it's fallen quite a bit. And my question is now is, hey, is this on sale? Because if it was up here, and their balance sheet now is improved, they've done some things to improve it. Is this on sale now, right? Have they pruned an apple off of this is what I'm asking. Have they pruned some leaves off this? And now are they going to be able to, focus on their core business and do better? AT&T is doing the same thing, dude. What AT&T did is we do phone stuff. And they said, well, how can you, grow your business? Well, we can keep more customers. And that comes from having quality, right? And good customer service. Okay, next, we can get more customers. That comes from your offer and your advertising, right? Hey, we have a good offer, we're competitive against the other people, and we add. Okay, so we can get more customers. Okay, then the other thing is we can sell more stuff. And this is really one that hurts companies. Sell more stuff. They say we already have all these existing customers. What else can we sell them? And this is what you want to be careful with, because you don't just want to come up with crap to sell people for the sake of wanting to grow your business. You have to sell them things that they want. And so they said, let's get into the cable business and let's sell the internet business and they got, let's buy HBO, or I don't remember what they did, but I don't think they bought HBO, but they're going to say, what are all these other things we can do? And this takes away your focus on what you're really, really known for and what you're good at. So AT&T is doing the same thing. They're pruning. So the question is, when this stuff goes down, to $40 or $45 or whatever it is that a sale? Is that a good price for what I want to pay? I says, all right, well, if I buy this and I buy this asset of international paper, how am I going to make my money? What am I going to get? Well, it looks like they're in a pretty good position to keep paying a dividend. So what's the dividend? If I buy this Jack in the Box and I pay this price, how much dividend is going to come out? And then the second is how much premium can I sell on my options? And so when I say, well, can this help me achieve my goals? Can this help me get to where I want to be? And is this something I'd like to be proud to own? And, do I mind being in the paper business? Are they doing something that's I don't believe in or against my values or whatever, right? And so great. I say, yeah, I like this. So on my risk graph, what my risk graph will generally look like is the first thing I'll do is I'll buy the stock. So I'll just buy, 100, 200, 500,000 shares, whatever I want to buy, okay? Maybe start out small. Maybe you say, okay, I'm going to buy 100 shares. But the minimum for me is always 100. The minimum is always 100 minimum because I want to sell options on it, And so I'll start with 100 to 1,000 shares. Like for example, with XLP, I started with 1,000 because I wanted to start a little bigger. So whatever it is, and then what I do is I'll sell a call, right? And then what I'll do is I'll sell a put. So I wind up with something like that. And the put is usually down here that if it falls, shares, not price. So it's 45, let's say. So the put will down here to say, hey, if I can get it for maybe 43 or 42, I'll pick up even more. If it goes up, then this money, helps you like cost basis. And if it goes up really high against the standard deviations, I can either buy it back or, I often right here will buy another 100 shares and just get called out at the, as soon as it hits the strike, I'll just buy another shares, and then off it goes, and I keep my original. So there's a lot of things in the playbook. That's where Noah's adjustment playbook is a big deal. So that was long. Was that boring? Did I
No,
ever
I enjoyed it.
Are you still awake, Noah?
Yeah, I'm absolutely. Hey, look, fundamentals. There's a lot of fun in fundamentals.
we put the fun in fundamentals. So the fundamentals are the income statement of income and expense, the balance sheet, assets and liabilities, and then the statement of cash flows, which says how much money came in from what we did, how much money came in or went from what we bought or sold, how much money came in from what we borrowed or paid back. And that basically is it doesn't take me that long to do what I just did. I mean, to teach it and walk through it takes a long time, but really, if I were to do this in real time, I say, all right, here's their income statement. Let's look at their revenues first. Okay, we're down a little bit, but not devastatingly bad. Okay, that's fine. We'll continue to look. Okay, let's find the net income from continuing operations. All right, well, down a little, not too horribly bad though. Let's check their balance sheet, see what they did. Okay, wow, that dropped a little bit. I wonder what happened. I don't know. Let's look at their total debt. Oh, that dropped a lot. Oh, probably had something that they sold. Let's look at the statement of cash flow. Operational cash flow, pretty steady. Oh, there it is. Yep, it wasn't a big deal here, but they did big moves here. Okay, what were these moves? Done. Let's go buy the dang stock. Once I see like a Kraft Heinz, I love boring stuff. I love it. People want to buy Bitcoin because it's sexy and it's making millionaires overnight and it's taking millions away overnight and it's just quick dopamine hit like cocaine of quick fixes. You know, I've used Kraft Heinz to teach for them for years because it basically went on sale because they had a big tweak in their balance sheet. They had what's called impairment costs. They took their brand equity basically and reduced it, and so their net worth reduced and didn't touch their cash flow one bit. So it kind of went like this, and this is what it looks like. That's the chart for like 4 years or whatever, and it's the most boring. I mean, nothing through the roof, nothing. I mean, Buffett bought it even higher. This is Buffett here. I got much lower than him, and you just keep getting the dividend, man. You just keep getting the dividend. And then what I'll do is I'll say, all right, here's my price. You know, maybe it's $45 for international paper. Okay, great. If assets, liabilities, income, and expense, now watch this. If I ignore this chart, and I don't care about the chart, I got in off the chart. I used technical analysis to get in, right? Saw this, that's what got my attention. Technical analysis said this, is it on sale, right? Is it at a support zone, right? Is it on sale? And I say, look, if I spend $45 on this and I get international paper and I get the dividend and I sell premium, how long will it take this to pay for itself? And if the answer is, less than 7 to 8 years, why wouldn't I do that? In this one, I figured out it'd probably be about 5. So if I can buy an asset that, okay, so, and here's where I get away from where I like investing more than trading a little bit, is if I were to give this to you for free today, let's say it was just 100 shares. If I gave you 100 shares of this for free, would you take it? Okay, yes. Okay, what if I made you wait 5 years to get it for free? Would you still do that? Yes. Well, in 5 years, if I have no more money in it, it's no different to me. Maybe a little different. I'm putting my work, I have opportunity cost, I guess, to think about, but really, and then once it's free, okay, once the $45 is gone, what do I care what the price does? I don't even care anymore. I have an asset that produces income for as long as the company is a going concern. And I don't really need to worry about ups or downs. And that's why I don't think what Buffett worries about it is most of his stuff's paid for anyway. He's just got the asset there, and he says, look, I just have this asset, because if your goal is passive income greater than expenses, you won't care what the price is anymore. You just care that you have boxes that spit out cash. The price doesn't matter anymore because you got it for free or got it paid for in 5 years or 7 or 8 years. And this is called compounding, and it takes time, and It takes temperament and discipline. And if all of a sudden, why would I sell it? Well, where I would sell it is if all of a sudden, for whatever reason, not because the price goes down, but because I can't pay it off anymore. That's if all of a sudden the dividend goes down and the premiums suck, and I can't say I'm going to attack that $45 number. I just as well, while I have the screen, Noah, do Bitcoin, right? I just as well do Bitcoin. Well, I've got it here. So I really didn't make a mistake. I just wish I would have waited a little while because I would have got double what I wanted. The problem with Bitcoin and Ethereum is the strikes suck. They just are awful. You have to make such a huge jump. Like if this were a $20 stock, you'd like to see 20, 21, 22. And the problem is your jump in deltas right here is massive with each one of these. The delta changes huge with each one of these. So it's hard to find the sweet spot, and sometimes you just got to take. So right now, I wish I was doing this today. I would love, love, love to sell this today and get $2,000 for it, get 1,900 bucks for it. But I can't be too upset because I think it was around 45 or 42 when I did it. I got $1,000 for it, and I've gained a couple $1,000s in capital gains. So I'm not too upset, but I would have liked to have waited, and then I'd have gotten both. But I can't tell the future. So I looked at the standard deviation of this on expiration. It was right around 50K, in the probability cone where Bitcoin was. So I sold that one. I brought in $1,000. Now let's just take that simple $1,000 right there. If I can do that for the next year, okay, that'd be $12,000. If I do it for the second year, that's another 12, another 12, another 12. So 4 years down the road, I've got $48,000. True?
Mm-hmm.
In 4 years, I got $48,000 in 4 years. My black pen doesn't show up very well there. You follow? So the idea is how fast? Well, we've been doing this as a fun experiment with Bitcoin, and we started off with an account of 56,000. We put $56,000 in the account. We kept $1,000 in cash, and we bought a Bitcoin for 55. Right?
Yep.
Well, the price is down to 47, but our account's at 60. Why? And we have 4, I think we have 3 now. Yeah, we have 3.2 Ethereum added that we didn't have before. Why is our account doing pretty well? Considering now that's not a lot. When did we start this? In November or something like that? November, December, January, February, March. So 5 months ago. So that's only about $4,000. It's less than $1,000 a month. That's about what you get on a rental house. A lot more riskier than a rental house. So that's the Bitcoin, and I just sold when it expired. What I did is I sold short the 50,000s, and it's a lot more now. I only got $1,000 for it, but that's still not too bad to get $1,000 in a month off a $50,000 investment. What percent is that?
1,000 a month off of 50.
So that 500 would be 1%, so 1,000 would be 2%. So that's 24% a year extrapolated out, annualized. And then I said, I'll buy half of it back if it dips, and they didn't do it. So it's not going to even be close now. I mean, my thing will be clear down here now. I wanted to see if I could get I wanted to see if I get 900, buy it back for 900 because I sold it for 1,000 because I thought it might go up, and I want to do this, but they didn't buy it, so I can just cancel that order because no one's going to buy that. And the Ethereum might look a little better. Now, I'm going to tell you something interesting about the Ethereum, then I'll let you go back to International Paper. On the Ethereum, there's 10 contracts equals 1 ETH. So I had 40 contracts there, and it looks like I've lost 8 of the contracts. I had 4 Ethereum, that's 40 contracts for it, and I lost 8. This will blow your mind. I was telling Corey this. So when I got called out, I had sold a call at a $4,000 or at a $3,000 strike. So I had 3 at the $4,000 strike and 1 at the $3,000 strike. And obviously it expired above $3,000. It was like 3,100 when it expired. So why didn't I get called out of all of them? Is the question. Why do I have 3.2 instead of 3? Because the guy had the right to take. I had 40 contracts out. I did that verbally. Look at this. I had 10 at a 3K strike, okay, minus 10 at a call sold at that strike, and then I had 30 at the $4,000 strike. So these expired worthless, but these all expired in the money. So why is it that he didn't take all 10? Because 40 minus 10 would be 30, which would be 3 Ethereum. Instead, I have 3.2 Ethereum. Why didn't he take all of them? That's my question for you, Noah, and you'll be blown away at the answer.
Well, that is a great question. I don't know why.
I know you won't know why, because it's so incredibly insane that it would not even be in your purview. One of the dumb things about this LedgerX, there's a lot of dumb things here about this. Number one, their strikes really suck because they're so far apart. You can't get the premiums you want. You either have to take too much risk or take very, very little premium for high probabilities, right? You don't have that middle of the, like if these were $100 strikes, you could find the sweet spot pretty much every time. Here, where you either got to go 3 or 4, it's kind of tough. I'm going to do 4s here in a minute, but it's kind of tough. The other thing is their spreads really suck. Their spreads are too wide. Their liquidity really sucks. I was showing a friend of mine how he wanted to buy some puts on his Bitcoin, protected puts, and then I showed him like the S&P 500, and they have $1 strikes on a $3,000 thing, just like this. Like the S&P is comparable, right? It's about at the same level ETH is. Can you imagine trying to trade the S&P 500 at $1,000 strikes?
No.
I mean, it's just you out of your mind. And then I showed him the spread was a penny instead of like, $10 here, $200 sometimes, or $10. So anyway, I really guess the other thing that sucks is you'll never believe this. If you want to exercise an option that is in the money, you actually have to send them a message the day before expiration saying, yes, I would like to exercise this option that is in the money. And if you don't follow up manually, and so obviously 8 of these contracts were with one guy that knew what he was doing. 2 of these contracts were with some other dude. This guy manually said, I want to execute. This guy just probably assumed it either happened or lost track or didn't know what he's doing. And so this guy did not get to buy it at 3 when it was at 3,100. He didn't get to do it, and he lost his premium. And if I knew who he was, I'd call him up and say, dude, let me help you here. I promised you, I made you a promise that I would give you this stock at 3,000. I'm willing to keep that promise, dude. Here, I hate to see it, but I don't even know who he is. I couldn't even find him if I wanted to.
Yeah, it should be randomly assigned, right? And so you got I wouldn't have even thought of that.
Well, who would in this day and age? I mean, we can put a man on the moon, can't we? Auto execute our options.
Well, yeah, I mean, with stocks and futures and everything else, it's automatic. Like those are settled automatically. So
that would never even be in our purview. So I learned something. I knew when I read the agreement and set up, I knew you had to do that. I just never thought it would actually happen ever. I never thought. I mean, it's so interesting in this day and age that stuff like that in the infrastructure is still lacking, and you still have to kind of know what you're doing. or you're going to be in trouble with stuff. So isn't that nuts? Someone's at my
That
door.
is.
Not going to
That's
answer it.
interesting.
Yeah, really interesting stuff. Anyway, that's long-winded, and we got to sell some calls here. So we have three. So we have one Bitcoin that's locked up. We have no cash that's locked up. So I'll tell you what I'm going to do. I'm going to sell a put to buy at 3,000 right here. So that's the first one we're going to do. Hang on, Mike. I got this smart home that is not very smart. Hang on a sec. My intercom, my doorbell automatically turned on as if I wanted to talk, and I don't want to talk because I want to talk to my buddy Noah and my Mentor Club family. Okay, so this spread is awful, 152, 170. We'll look at what the recent ones were at, 151, 142. So it doesn't look like they're ready to cough up the 170. It looks like it's more towards the 150. So what do you think, 160? You happy with that?
Yeah.
161. We'll just go 160. And we can do 1 or 10 contracts there. So we're going to sell short 10 contracts at 160, see if they bite. The collateral may be assigned at $3,000 for ETH, so we got plenty of money to do that. And we'll see if they bite. We'll bring that in. So basically what that looks like on a financial statement is we have an extra $3,000 in cash, right? We got enough, right? Well, we got enough right here. And that's an asset. And we say, we're going to make a promise. You can give us 160 bucks that we'll buy. We'll take that $3,000 and we'll buy another ETH with it. So we're going to get paid $160 to buy this cheaper than it is today by 10%. So we'll buy it at 10% discount. That's fine. We'll do that happily and easily. Our average cost basis on this ETH is about 3,500 on the others. Okay, then we're going to take the ones we own and we're going to say we'll sell them at 4. Happily, we'll sell at 4. And it looks like 111. It's really close to the bottom part of this. The order book, 111. So what do you think? They're not really biting on, we'll go in between at maybe 115. So we'll say we'll do 30 of these at 115. And at I'm sure people would love that at that much. I don't think anyone would really bite on that. At 115, and we're going to do 30. So that'll bring in $345 of premium. So let's go ahead and do that. And what that looks like on the financial statement is we have the 3K, but we also have the 3 ETH, right, as an asset.
Mm-hmm.
So this is going to bring in, if it takes $340, and this is going to bring in 100 and what did I say,
160?
$60. And then we got one Bitcoin right here, and that brought in $1,000. So that's the cash flow of the Bitcoin, and so that is 1,000.
500, isn't it?
Let's see, 60 is 4. Is that $1,500?
Yep.
On a $60,000 account. That's pretty good.
Yeah.
And here's the other thing, you can't do more. If that's good, why don't I do 5 Bitcoins or 10, right? Well, there's a good reason for that. Number one is you got no liquidity here. I mean, I'm trying to get rid of let's just look at this. I mean, well, there's 6 Bitcoins, so this guy's, excited, but really there's 1 Bitcoin. There's another one, but these are pieces of Bitcoin. There's 4 of them. I mean, you're dealing with very small amounts of, how would you get the liquidity? This guy can't, this guy can't. So interesting stuff, huh? Man,
Yeah.
the guy's willing to buy that many. Maybe he's trying to cover something else he's doing. The other thing that sucks about this is that you can't really do spreads because there's no margin account here. You can't trade it on margin. It's too volatile. And so to build an iron condor in this would be really, really tough because all your short options would have to have enough cash to, to cover a lot. You just wouldn't be able to do that. So isn't that interesting?
Yeah.
Especially on your call side that's infinite, they wouldn't be too excited about that. So
Nope.
they don't let you sell naked calls in this, I don't believe. So
Which is
anyway,
probably not a good idea anyway. There's a general rule among traders: don't sell naked calls.
yeah, and everyone says, well, Bitcoin's the new thing, great thing. Really, what's fun about this is a gateway drug to just getting people to calm down and say, wow, wouldn't I just like to have a paper company that, like, if you pulled up in a Ferrari and you're dressed to the nines and your wife is dressed to the nines and you walk out Ferrari looking great and someone says, gee, what do they do? I mean, I don't drive a Ferrari, I drive a Ford truck, but but let's say if I could fit in a Ferrari and you did that and you got out and they say, wow, man, those guys must be loaded, or whatever perception you want to put out there, if that's your deal. And they say, what does he do? He says, well, he sells cheese to Domino's Pizza.
He's the cheese king of Salt Lake City.
He sells cheese to Domino's Pizza. And like cheese, that's like curdled milk. I mean, the guy sells, curdled milk for a living. That's what he does. Yep. So Tevye is looking at that and saying, well, if I were a rich man, I'm Tevye the dairy man. Why can't I do that, right? If you're a tycoon, it doesn't matter if you're selling cardboard. What do you do? He owns International Paper. He sells cardboard. What would really be interesting, he said, well, he owns AT&T, he owns Apple, he owns, cardboard, he owns Prudential, he owns Hanes underwear. All these companies you can just rattle off, he owns. Well, you and I, we're not, tycoons, as students here, right? You and I are students plugging along. But if you just buy the assets and get the education, some are going to go up, some are going to go down, but at least you got a chance now at having some asset. And maybe for you, maybe you're more like me and you don't want a Ferrari. And it's okay if you do. Maybe you just want freedom for your family and to give them a good life. And you want to die knowing that, well, I did my best I could to leave a legacy for, a dynasty. I thought dynastically. I care more about my kids and I want to give them a head start or teach them. And then their job is to say, I get it. What dynasty is about is dad took care of me, I take care of mine, and he takes care of him. And you become a steward of the dynasty, and your job is to make it bigger while you're a steward of it. That's your job. And if you don't do that, then you don't have a good family name. And if you have a daughter, her name is Paris, good luck. She could destroy your fortune. Or
Well,
maybe
that is why dynasties end, is it not?
Yeah, they end because of emotions and being dumb. Okay, that was long. Sorry. And we
Oh no,
wanted
it was fun. It
today.
was very educational. I
Put a
enjoyed it.
nickel on me, and we'll go for an hour and a half. Let's go to International Paper on your side. We're doing a little bit now. You can trade this just as well.
Yeah.
Like let's
Well,
say
so I've got this really cool friend of mine named Andy who does all this fundamental research on companies, and from time to time will send me a text message and say, oh, I really like this this asset. So I look at that, I go, okay, I could build a plan off of that.
So I had the chance to buy this on that. See this little dip down there?
Yeah.
Thing is, I got a chance. I don't time it very often, but that little $42 area
Yeah.
down there, I can't remember what I got
Well,
it at.
if you look at the big time frame on the chart, I mean this stock price, it is on sale, but it's compared to where it's been over the last decade, it's
I
still at
bought
a pretty
stock
good value.
I bought this stock at $42 and change.
Yeah, and so like, down here, $40 was a known support resistance zone, and $50 looks like a little resistance zone. It's been as high as 66. So I decided to double dip on it with the plan to buy the stock. So just like you bought the stock first and then sold a put to buy more,
Yep.
I went with a game plan I would plan to buy the stock, but I started out selling the puts down at the bottom like you did. And then as it ran up a bit, I decided to sell the calls and double dip. And I still have a plan to buy the stock, but what I did is basically, I think you'll like this. Sold the $43 put for $1.25. And that was the promise to buy 200 shares down at 43 with the $1.25 of credit. That puts the cost, that would put the cost base down at about 41.75 or so. And that's down to the same support zone we were talking about, right?
Yep.
And then I looked at the chart out here and I could see resistance out here at 49. And the prices were starting to rise. And I saw it come into this old support resistance zone a couple days back when I saw red candles come in. I go, you know what? I wouldn't mind selling the stock, and I don't own the stock yet, but selling it out at 49 or so. And $48 plus a 55-cent credit, all that together gave us a total credit of $360. So $180 per 100 shares.
Way nice.
So I mean, yeah, but I don't have the stock, so I have that
though,
naked call risk.
What's cool about this though is, let's say you wanted to buy 100 shares next month. When this is in May. Well, you've got if this works out, you got $400 basically, almost $400 to put towards. Let's say you just bought 100 shares towards a $4,300 investment or $4,600 investment.
Yeah.
That's almost 10% of the way paid for out of the gate.
Right. So, I mean, that is a pretty good deal. And then I was looking, that dividend's awesome. I wouldn't mind getting that. So you don't mind owning the stock. And you'll notice I have a buy stop order sitting out here at $48.
Yep.
And the reason I decided to set that buy stop out at 48, well, that's the stock price is continuing to rise. And I've got the promise to sell it at 48. So I thought, well, if I buy it at 48, I get to keep all that premium. And if I have to deliver it at 48, I still get to keep the $360.
It's such an important lesson in a bigger picture. Is people tend to think, I was writing about this, I'm rewriting the stock market cash flow, and I'm up against the deadline, so I'm really making the final tweaks to it. And I was writing a little bit about context and about this. And one of the things that people do as human beings, and all animals do this, is animals think of good and bad. The deer goes out and eats some foliage. Oh, that good, tastes good. Foliage, good. Oh, mountain lion, bad, right? And we either, in our brains, based on how we feel, an amoeba can have, it doesn't have sentience, but it does know food, good, predator, bad, right? I mean, it'll defend or attack, right? Everyone, or run. So every organism, it seems, has fight or flight almost.
Mm-hmm.
Certainly vertebrates do. And so we tend to have this limbic system that says good or bad. And as a result, we wind up in a habit of binary thinking of what's best. What's best? So if you look at what Noah's done, you look at what I do, which is best? And that's what people screw up in is, look, the reality is Noah and I can go to Baskin Robbins. We could go there, dude. You can see where I'm trying to.
Are you inviting me to Baskin Robbins? Because I'm there. I
would love to have a mandate of not healthcare mandates, but like a Baskin Robbins date with a man named Dodd. And let's do a Baskin Robbins mandate and say, now maybe I get vanilla and you get, pistachio. We're enjoying ourselves. We're getting our ice cream. We're achieving our goals. So depending on your style, some trades might work out better, much better than, like right now, his cash flow will be much bigger than mine that he's making on his cash, right? And he can turn around and buy the asset or what he wants to do. And neither are better or worse. And a lot of it depends on the size of your portfolio, what you like to do, what you're good at. Um, this is a great example of having more than one, uh, opportunity, more than one. So
Right. Well, yeah, there is no right or wrong here. It's just you have a plan to own the asset, collect the dividend, and to buy more if it dips.
yep,
I have a plan to collect the cash flow and buy the stock if it goes up.
yep,
And either way, at the end of the day, we both want the paper box that pays the dividend.
that
Um,
money.
yeah. So I mean, from now on, when you draw your little paper box with the box with the crank
It
on
could
it,
be
it's a
cash with
cardboard
the
box.
cash. Yeah, there you go. It's cardboard box, but
Yeah.
it could be cash. I mean, right now we're making money on our short put with Ethereum. With our cash represents the box. The money is working for us.
Hmm.
So you can do it just the same. It's interesting. The one thing I didn't disclose, I also have a naked call that's further out of the money for May on this, simply because it was a rich premium.
Yep.
And I don't care if I have to buy some at that strike to delta hedge it. So I
Well,
have some.
and that's such a simple plan. Look, I promised to sell it at 48,
Yep,
and they paid me 55 cents. And then if the stock rises, all I have to do is buy it at
yep,
48,
yep.
and I'm covered. I now have a covered call. And so it just shifts my risk profile. If it starts to rise, and I've got this automated, like I don't even have to sit and babysit this, Andy. This
Not
order's
like
good till canceled.
Bitcoin, not like Ethereum.
Yeah. It's much easier to manage trades on a stock like this than it is to manage the entry and exits and order, just because of the liquidity. I mean, these are so liquid and the spreads are so reasonable. So I have this pending buy stop order that's good till canceled, so that if it rises, it automatically will put me into a covered call, and I don't have to stress or worry about, at the end of the day, that'll give me a cost base at 46.21, which is kind of about in the middle of this range here of resistance and support. And so, I'm not getting it right at the bottom. That's okay. I'm getting it at a good value, and I kind of base that off of this premium on
Yep.
the dividend, or not the premium, but the dividend being 10% of the stock price, or 1% of the stock price, excuse me. So,
What's the plan?
46 cents.
Well, times 4 times a year.
Yeah. Well, and that makes what's that? $368 a year on 200 shares.
That's
So,
that's pretty good. What's interesting is you're bringing in. Let's say you end up buying it right, about where it is. You got basically a better cost basis than I did, because you've already made so much money
right.
off. So if you decide to buy it, it's almost like your cost basis is where mine is anyway. That's what's cool.
Well, this
Option.
is kind of a fun trade. And these trades are so unexciting. Like they don't register on the emotional scale. You don't feel like a lot of traders I've met over the years are kind of adrenaline junkies,
Bad.
and they love the thrill and just the emotional.
Yeah.
They get a lot of, and I don't think that's necessarily, and I've it's not necessarily healthy as far as temperament goes. And not everybody has the temperament to be a trader in reality, just because it can be such an emotional roller coaster.
Yep.
So I like a good simple game plan. Looking at stocks, and if I ever speculate on directional stuff, like purely directional stuff, what I did last week is I built a bunch of broken wing butterflies and used some leverage to pick up and control, well, not pick up, but to control a bunch of energy stocks. And I wanted to get some mosaic because of the agricultural stuff we were talking about, and
Mhm.
basic materials were looking strong. And so I built out a bunch of broke wing butterflies, and most of them are doing well. We got one that's losing a little bit of money on Apache, but rather than tying up a bunch of capital on speculation, I tie up the capital on the core strategy, like the international paper, and
I
I want
think
to
the
own
way to
that
look at
stock.
that, the way to look at that is, if you just chose one of those broke wing butterflies, just look at the purple line. You know,
Yeah.
just look at
Well,
the
no, yeah, look, like here's Mosaic. Like, so this was a simple one where I was, thinking about the wheat that we were talking about earlier, and I was thinking about the need for fertilizers and whatnot.
Mosaic
And
up. There you go. Look at the
Mosaic,
purple line. No,
yeah.
you
So the
got it.
stock's
Look at
running,
the purple. Yeah, on this risk graph, the purple line looks like a stock.
right? It does,
What a stock
and
would look like. The purple
exactly.
line looks. If you bought that stock at 67, that's had you bought the stock at 67, that's what your graph would. The purple line looks like a stock trade,
Yep.
but you don't
And
have to
so,
spend the same amount of money to like this would be how many shares?
well, look at our delta here. It's at the current stock strike price, our delta is about 117. So 117 shares times, call it our break even point right now 67.50. Call it 67 just to make the math easy.
The math still.
What's 117 times 67?
Yeah, I do 10. I do 100 times 60 or 70 and round it
Yeah.
around. But what is
So
it?
107, that would be $7,839 in a cash account to buy.
$1,139.
Yeah.
Yeah.
So that's how much capital it would take. And our little position here cost us 1,980 debit. So
Tough.
yeah, so we have the same exposure, reward, and risk. And it's easy enough to see this little alert here. That's my exit strategy. So that if the stock price dips down below 59, we'll keep the losses under $1,000. If we're right and the stock price rises up, and these are good through June, if we're right and the stock price rises up, we could make 1,000, 2,000, 3,000. Our max gain out at the right's 4,000. And I don't know if the stock's going to continue to rise. This is just a speculative theory I have that, well, we're going to need fertilizer, and these guys produce it. That was pretty fancy thinking, I suppose, but
I think it's pretty awesome.
so, and that's what we did last week in the Mentor Club is we built out a bunch of these broken wing butterflies, and just kind of checked up on the portfolio. I've been organizing the portfolio by strategy, and I've got cash flow stocks and a couple of our long stock positions. We've got some stocks where we have covered calls running, and just kind of working on categorizing my trade management and thoughts by strategy. And you don't have to be this sophisticated or fancy. I mean, we got a lot of stuff going on in the Mentor Club, and so we're always trying to teach new concepts. And I thought I'd break those down by category. Most people wouldn't have to get that fancy though. But
it's very artistic with your.
It is. I've tried to make the risk graphs.
I couldn't have done that. Very cool. Very fun.
So
no, I've ever told you I appreciate you before because I sure do.
Well, you never let an opportunity go by to express that appreciation. I feel the same way. Appreciate you and all that we do together. And
fun stuff. I'm going to do a little plug for Quick Start Labs. If you haven't met those and you've signed up, we'll be halfway through. We have one today at noon, so I'll go get ready for that one. And the last one we got, I've been long-winded lately. We did like a 2.5 hour one where we did all this fun stuff and taught all this cool stuff, and we were laughing and people were having fun. But one of the questions every year we've usually done a special for advanced courses. So if you attend, you'll hear about those. I don't know if I'll talk about them today, but sometime during the time we traditionally run a special for people that complete the Quick Start Lab for the year. So there's some fun stuff going on there. Easy trades, shooting fish in a barrel, fun stuff. So
well, send me a link, and I'd love to sit in on the Quick Start Lab with you guys if you would have me.
Okay, awesome.
All right.
You're all invited. Thanks, everybody. We'll see you next time.